Somewhere in Carmel, California, in the last weekend of July, a wedding planner was finalizing table settings for a multi-day celebration, a ceremony at a Tuscan-style villa, a send-off at a forest spa. And the groom was upstairs, watching $35 billion disappear. Not over the course of the wedding, over the course of about 2 weeks. The bride later put it on social media better than I could. Their wedding planners, she wrote, kept nodding sagely and taking notes because they'd clearly concluded the couple had lost their minds. That groom is Leopold Aschenbrenner, 25 years old, and 2 weeks before his own wedding, his hedge fund went from managing $45 billion to about 10. That's not a bad month. That's one of the fastest evaporations of capital in the history of Wall Street, and almost nobody outside finance Twitter noticed it happening in real time, because everyone was busy asking whether AI was actually going to be worth the trillions being bet on it. So here's the question worth actually answering. How does a 25-year-old end up managing $45 billion in the first place? And what specifically did he do that turned a great year into a historic collapse in 14 days? Let's get into it. Number 1. Aschenbrenner's path to Wall Street did not go through Wall Street. In 2024, he published a sprawling 165-page essay called Situational Awareness, arguing that artificial general intelligence was coming faster than almost anyone in public was willing to say, and that the implications, economic, military, geopolitical, were being wildly underestimated. It went viral inside the tech industry. Tim Ferriss, after interviewing him, called him about as close to clairvoyant as you could possibly be. Before that essay, his resume had 2 notable lines on it. He'd worked at FTX Future Fund, the philanthropic arm of Sam Bankman-Fried's crypto exchange, which is also where he met his now wife, Avital Balwit, now chief of staff to Anthropic's chief executive officer. And he'd worked at OpenAI until he was fired in 2024. OpenAI's stated reason was an improper disclosure of internal information. His version is that he shared a mostly non-confidential planning document for feedback, and that the real friction was over security warnings he'd raised. Whichever version you believe, he left as one of only 2 people on record who refused to sign OpenAI's exit non-disparagement agreement, reportedly walking away from a substantial equity payout to do it. None of that is a trading track record. It didn't seem to matter. Backed initially by roughly $225 million from investors, including Stripe's Collison Brothers and Daniel Gross, Aschenbrenner opened Situational Awareness, a fund built almost entirely around one thesis: that the AI build-out was real, underpriced, and about to accelerate. Number 2. The trade. For a while, the thesis printed money. The fund reportedly returned somewhere around 10 times its value over 2 years, and several 100% in the first 5 months of this year alone, on a portfolio built around AI infrastructure names, chip makers and data center plays like CoreWeave, Nebius, Micron, SK Hynix. Here's the part that actually matters, because it's the part that later failed. A fund like this is supposed to hedge. The textbook version of a long-short fund buys the stocks it likes and shorts the stocks it thinks will underperform, so that if the whole market drops, the losses on one side get offset by gains on the other. Situational Awareness did technically have both a long book and a short book. The long side was AI infrastructure. The short side was software companies, names like Adobe, Salesforce, Intuit, that Aschenbrenner reportedly believed would be disrupted or commoditized by AI rather than benefit from it. Notice the problem before I even say it. Both sides of that bet depend on the exact same underlying story, that AI is about to transform everything, fast. That's not really a hedge. That's the same bet placed twice in opposite directions on the same theme. If the AI narrative cools even slightly, you don't get protected on one side while you lose on the other. You lose on both sides at the same time for the same reason. And on top of that single concentrated theme, the fund was reportedly running roughly 4 times leverage, meaning every dollar of investor capital was controlling something like $4 of market exposure borrowed from prime brokers on Wall Street. Number 3, the meltdown in 2 weeks. In July, the trade reversed, hard. The AI infrastructure stocks started sliding as investors got nervous about the pace of AI monetization. At the same time, the software names he was short did the opposite of what he needed and rallied. Both legs of the portfolio were now losing money simultaneously, and because the fund was levered roughly 4-to-1, those losses weren't just doubled, they were magnified far beyond that. When a leveraged portfolio starts losing value fast, the lenders who provided that leverage don't wait around. They issue margin calls, demands for more collateral right now, or they start selling your positions for you into a falling market, which pushes prices down further and triggers the next round of calls. That's the mechanism that turned a bad month into a historic one. In roughly 2 weeks, the fund's value fell from $45 billion to around $10 billion, a loss on the order of $35 billion, reportedly one of the largest and fastest drawdowns any hedge fund has ever posted. And this is the part where the timing turns almost absurd. The worst of it landed the same week as his wedding. Aschenbrenner reportedly took investor calls and, by his own account in a letter to investors, took full responsibility for what had happened, while also, according to reporting, fielding some of those conversations during his own honeymoon. Number 4, the rescue that wasn't really a rescue. With collateral calls mounting, Aschenbrenner's team reportedly went looking for buyers for the leveraged public positions, essentially asking to sell the portfolio before the lenders sold it for him at an even worse price. Ken Griffin's Citadel ended up acquiring the bulk of it, reportedly at more than 10% below market value. Call it a rescue if you want. It's really closer to what happens at any distressed sale. Someone with cash, patience, and decades of risk infrastructure shows up and buys assets at a discount from someone who has neither the time nor the leverage, pun very much intended, to negotiate. Citadel didn't do this out of charity. It did it because a forced seller in a hurry is exactly the counterparty a firm like Citadel is built to find. Cliff Asness, who's run the quant firm AQR for 3 decades, was asked what he made of the whole episode. His answer, more or less, file this under "you never go full Kelly." Wall Street shorthand for building a portfolio around the maximum possible return with no real regard for the risk of losing everything. Coming from someone who spent 30 years managing other people's money, that's not really a joke. It's a diagnosis. Number 5, the Encore. Here's the ending that tells you the most about how Silicon Valley actually processes this kind of event. Within days of the near collapse, situational awareness didn't shut down, didn't go quiet, and didn't spend the following month rebuilding trust with rattled investors. It put another $400 million into a private startup investment, on top of $100 million it had already committed a month earlier, bringing that single private bet to roughly $500 million. In his follow-up letter, Aschenbrenner framed the entire episode not as a near-death experience, but as a correction. He wrote that the fund had taken the steps necessary to fight another day. Whether that's confidence or denial probably depends on what happens to that $400 million next. But the mechanism that got him here isn't complicated, and it isn't new. Concentrate a portfolio around a single narrative. Call the two sides of that same narrative a hedge. Borrow 4 times over to size it up. And wait for the 1 week where the story wobbles even slightly, because at that leverage, it only has to wobble once. If you want to actually understand the math behind why leverage does that, why a levered portfolio can have a great average return and still go to zero in practice, that's genuinely worth its own video. Subscribe if you want it when it's out.